Well, the U.S. Federal Reserve might have cut interest rates by 0.25% for the second time this year. Analysts in Singapore believe impact on local mortgages will be limited, well, at least in the short term. Michelle Teo explains.
30-year-old Jermaine Chow is a property investor, and she will be one of those benefiting from a lower interest rate environment.
Every single month our mortgage would be lower, especially when you rent out the unit. When the mortgage is actually lower, that would mean that every single month our positive cash flow will be higher, and that is a good news for us as investors.
But the immediate impact might be limited. For instance, the 1-month Singapore Interbank Offer Rate, or SIBOR, stayed constant the day after the first cuts were announced in July, while the 3-month rate fell 11 basis points. And although this has continued on a downward trend, economists say that doesn't mean loans will be priced cheaper.
If those mortgage loans as well as corporate loans are tied to the SIBOR, then naturally, it will imply that those rates will likely also moderate marginally. But that being said, the business environment has become more challenging. I think the risk premium actually has increased. Banks, lenders would have to take into account all these risk considerations in pricing their loans.
Still, mortgage advisors believe there is space for further easing for different loan products.
So when you place in the spread of what the banks need to charge, essentially you have an anomaly in the interest rate environment whereby floating rates are higher than the fixed rates. So with this new cut itself, I definitely would feel that there should be some room for further drop, say, in the SIBOR. Not substantial amounts, but what happens is that with the drop, it's just probably going to bring your floating rates to be relatively on par with your fixed rates or slightly below.
And with the rate cut signal sent by the Federal Reserve, this could also impact policy decisions by the Monetary Authority of Singapore.
Obviously, there is significant downside risk on growth. And on the other hand, inflation, even though going forward, could pick up, particularly against the recent spike up in oil prices. But I guess the more immediate risk to the Singapore economy is that of growth. So therefore, I think the MAS will likely ease its monetary policy by flattening or moderating the slope of the policy band.
Analysts say flattening the slope will make the Sing dollar appreciate at a slower pace. MAS is expected to issue its policy stance in October.